Hey everyone, welcome to our fourth slide, which is industrial appraisal. So here we've got a funny quote that I love, that says, "Protect your downside as a young entrepreneur by doing a good analysis before investing." Right? So it's a good thing for someone to do what you call industrial appraisal, so that you protect your downside. You don't do some stupid things when you are investing your money in any kind of business, right? So let's get straight into our slide. So industrial appraisal, right? We are saying before pressing a button, right, on brokers, throwing your money, a good analysis is required. After understanding all the concept, then come the fighting spirit to make money. So we are generally saying, after you're done with understanding everything, the pitfalls of the markets and everything, come the fighting spirit, so that over time you become a profitable trader, right? So here there is a nice diagram which shows us a flow of an order in the markets, right? So here you put your order, whether you are buying or you're selling, then it's supposed to go to a broker, right? Then a broker passes your order to investment banks. Then these investment banks, they pass this order to one central exchange point where these orders are cleared, right? This is ICE, right? So, but the question is, who is controlling these prices of these stocks, whatever, of our orders? The thing is, we find out there are people, or it's a controlled thing, right? Which means it's monopoly, it's monopolized, right? There's pricing control there, right? But it doesn't mean as traders we should stop making money in the markets, right? We should take advantage, know how to make money over time. So the thing is, we are saying this thing, it's a controlled thing, right? Which means the infrastructure is not built for you to benefit over time. So you should be woke, right? Should have eyes, you should be vigilant, right? So here there's a picture, a nice picture. You see these goats, they are trying to feed on the other side of the fence. So this picture, it depicts a image that says, what pros do not want you to know, to know what they are doing this side. These guys who are making money in big institutions, right? So that's what we call the other side of the fence. What the pros, professionals, people are doing it, people with a control function in big institutions, they don't want you to know, right? So we always say it's good to always do an industrial appraisal, because we believe that regulations are passive. Hence, regulate yourself by having a self-discipline, right? So sometimes you don't need to rely on regulations of government. You can get scammed by these brokers, by anyone who comes to you thinking that he knows what he's doing. So always say, know that regulations are passive. Things can get regulated after 10 years, right? Or 5 years. By the time those regulations they come in place, we have maybe lost your money. So you should be woke, right? There's a scenario in Singapore in 2018. There was introduction of IB contracts, right, where people were hired to persuade retail traders, you guys who want to get who are trading at home, to deposit their money in the brokerage side. So the thing is, in 2018 in Singapore, these guys, they started to hire people. Those people are so-called trading educators, so that they go in public and try to convince people by teaching bullshit to people, thinking that these people come in volume and deposit their money in the brokerage side to the broker, right? So, but due to conflict of interest, these contracts were banned, right, in Singapore. So those are the case studies that were found in Singapore. These guys were trying to increase their volume of order size so that they gain money from what we call commission, right? From what we call commission. You know, commission is just a simple way that you get paid a certain percentage when you do your job, right? Sorry about that. Let me rub it. Right. So I think we've explained enough. You should regulate yourself, because this thing, there was a case study that was done in Singapore, so you should be awake, right, as I explained. So remember one thing, as a trader, when you get yourself in this industry, a trader is a slave to volatility. So what are we saying about this word, volatility? What are we saying? We are saying these are high fluctuations. So the market, maybe it's moving like this and this, it's not moving like this. These are high fluctuations. So high fluctuations in the market, they bring what you call opportunities where you make money, and it's very high risk, right? You can lose your money, right? So how do these markets end up being like this, what we call liquid markets, right? So the main reason is because of more participants that are increasingly being that are increasing in the markets, right? So more participants or more people are coming in the trading industry. They are surpassing what we call volatility, which means they end up resulting in what we call liquid market. This is liquid market, like there's no fluctuations, high fluctuations in the market. So which means if someone wants to buy something, there's a quick seller, right? More willing buyers at the same time. So which means there are no fluctuations, where someone who's buying here may end up maybe selling in this position, right? So hence assets do not move in liquid markets, right? We are saying they are not moving because there is more buyers and sellers at the same time. You want to buy something, at the same time someone is selling it, there is no movement. Hence liquid provide. So the thing is, one thing you should know about this concept is this, what we call liquid markets here. Let me just write L, right? Liquid markets, these are volatility markets, right? Let me put a thing like this. So this provides what we call liquid position for professionals to get out of the markets, right? So professional people, they find this is an opportunity to get out of the markets. Whether he buys here, he sells here in liquid positions. You find these as liquid positions to get out of. So most retail traders, they don't know about this, right? It's very, very important. Take advantage of this liquid position to get out of the markets or get in. You may buy it here, right? And get out at a liquid position again, right? That's how professionals do their stuff, right? So high technology is also surpassing this industry by causing financial crisis. Generally, liquid markets, they cause these kind of things, financial crisis, like what happened in 2008. There was a scenario where there was a financial crisis, right? So the question here, you have here that people saying he's a professional trader, retail trader. At the same time, anyone is saying he's a professional trader. YouTubers, influencers, they're saying they're professional traders. But the biggest or $1 million question is, what is the difference between this and this? Be a professional trader and a retail trader. Simply being for someone to be called a professional trader, we are saying he's doing a controlled function, right? A controlled job where it's being monitored in big or a small medium, but is working in a controlled function. These guys, they are working on their bedrooms at home. There's no controlled function here, right? So let's get into these points, right? So we are saying a professional trader, these guys, they have a strategy over time to make money. They have a systematic approach, right? They have a systematic approach, right? But these guys, retail traders, they have a haphazard approach, right? They don't know what they are doing. They are just gambling so that they make quick returns or make money in a short period of time. They want to make money in a short period of time. But these guys, they have what you call risk adjusted returns, which means these guys, they are doing what you call calculated risk, right? They know that they are risking 2%, they are risking 5% of their portfolio, of their money, right? These guys, they're just risking maybe all of their money so that they make quick buck, which leads to what you call capital destruction, right? And also unrealistic returns, right? But these guys, they have what you call calculated returns, so that over time there is what we call consistency and growth, right? And what we call realistic returns, nicely, right? So remember one thing as a trader: when one sends an order, right, you buy CFDs, not an actual asset. So let's say you are buying an asset here, maybe it's a house. So in our markets, you are not buying an actual house, this house. You're not buying this, an actual house. You are buying you are buying what you call an underlying asset. There is a contract which says that this guy has bought a house of this net worth, maybe it's 1,000, right, USD, right, or 10,000 USD. Let me be realistic, sorry, 10,000 USD. So you are buying a contract, not an actual house. Beware, in the markets we are not buying actual shares or assets. We are buying what you call an underlying asset, a contract which just says that we have something like this, right? So this contract is just mirrors the price of that asset, right? To say, no, this asset is worth about this. So these are derivatives, right? So we are just simply mean that if you bought this house at 10,000 USD, right, this is mirroring, it should have a mirror price of this house, right, maybe at point A, right? So which means if we say these are derivatives, right, these assets are derivative, so which means if it changes price, right, maybe now it's maybe 12,000. If it changes price, to 12,000, right, which means maybe now this house is now at a point here. Over time, we are just saying it's not moving. Sorry, it's not moving. So don't get me wrong or don't get twisted here. It's not moving. So if it's here, right, which means this contract it's a derivative, it's changing in value. That's what we are saying. So which means if it moves from 10,000 to 12,000, you can liquidate your position, you can get out, right, by selling here. Sorry, here you've bought it by selling, which means you are making money by this difference. 12 minus 10,000, you have made your profit of 2,000, right? So which means if it goes down, it's the same way, you end up losing your money, right? So generally the case is in the industry is what we call conflict of interest. Be very careful. One should be very careful. The what we call 99 phenomenon, right? So the thing is, this phenomenon is just explained that most of the 90% of the traders in the industry, they lose money, right, in 90 days, in 3 months, right, most of the time, right? 90% of their money is lost in the market. So this industry is not there for you to make money. You should be very careful. You should be vigilant, right? So one may ask about depositing your money. What's really happening? So there's what we call a term that is very important for someone to know: margin. Here, this term. So margin is the actual money you deposit in the account to get leverage, right? So you deposit your money, right, in a broker. This is your broker. You deposit your money here, maybe 1,000, right? But the thing is, these assets, maybe 1,000, sorry, you deposit your money, right, 8,000, right? So most of the time these assets, they are very, very expensive, right? That's why you see these banks in years, in back the days, you see these big banks, they used to trade for themselves. There were few retail traders, people who've got money. But the thing is, there was introduction of brokers. So the broker, usually it helps you. Let's say this house is worth about 100,000, right? Get me here, it's worth about 100,000. You as a retail trader, you can't go and buy this, right? So a broker is someone who is there to help you. Not always the case, because they say what you call conflict of interest, right? So the broker is there to help you. So you deposit some money, so that you deposit your money, so that this broker can lend you maybe the rest is what, 90,000. So 90,000 plus 90,000, let's say this was 10,000, right? You're supposed to deposit 10,000, then the broker lends you 90,000, so that you can go and buy a contract for difference, an underlying contract, to say you have bought this asset of 100,000, right? So that's what we call margin. Margin is this 10,000. That's what we call margin. The actual money that you deposit to get some money or leverage, some help. A broker borrows you money, so that it borrows you this 90,000, so that you add your money 90 plus 10,000, so that you buy this. It is its pitfalls. It is what, but there are two types: initial or variable. We'll explain in more details about this, right? But the question is, why is it these houses or brokers, they help you, which means there's a certain way they want to make some, there is something that they are benefiting from, because no one comes to just help someone for nothing, right? So these guys, let's take a look about how do they gain their revenue from you and me, right? So the thing is, these guys, they gain their revenue in 4 ways, in 4 main streams of income. The first one is spread, the second one is commission, the third one is financing turn, OTC gain. I'll explain in more detail, just be patient, right? So the main objective of a broker is not mainly to help you by borrowing you some money, is also to make money. So let's take a look, how is these 4, what are these 4 terms that I have explained? How do they make money, these brokers? Suppose the objective is to make money as a broker, right? If you're a broker. So like I said, in the industry there is what we call brokers, right? And these trading educators that comes to you, maybe they teach you some bullshit thing, then they say you just need to know resistance line. I'll explain resistance, what supports, and what they give you. You know, those kind of videos these brokers they give you, right? They say they explain about pips, some bullshit things. It's not about just knowing few things then deposit your money. That's what we call those trading educators. They come, I feel like they come the bullshit crap things to you. And retail traders, so there's a relationship, very important. Broker, the educator, trading educators, which is sent by brokers to teach these guys, retail traders, you guys. So there's a very good relationship. So how the industry work and how is it set up for retail traders to fail? So mainly thing that you are supposed to know is the industry is made for you to fail, right? So that you lose money, because everyone wants the piece of a cake, right? These brokers, they want that cake that you are looking. Also, you are looking to have money over time. They also want money from you. So be very careful. So as I explained, how do they gain their money? I explained, I said spread, commission, financing, 10 OTC again. So let's take a look. What is a spread? One may ask. You have heard me saying spread. What is a spread? So this is money made by marking the spread. Okay, let me so a spread is generally a difference between what we call a bid price and an ask price, right? I was supposed to explain this in later strategies, so let me go here and explain to you. So what I'm saying is spread, right? It's just a difference between bid price minus ask price, right? So you may ask yourself, what is bid price, right? Very important concept. What is bid price? So bid price, right, is what you call buy price. In simple term, you can say it buy price. So what are we saying about bid price, right? So in the markets, the thing is, let me explain here. There is what we call buyers. There are two people, no, three people actually. What we call buyers, right? And what we call sellers, people who are selling. In simple terms, buyers are people who are willing to buy from these people who are selling, right? And there are people who are just watching these markets, like no participate, like these people. They are, what can I say, participants that are not doing anything, right? They are watching the markets. It's not always the case that is buyers. That's how people lie to each other. It's not always the case about market. Markets consist of three people: someone who is willing to buy something from someone, right? And the people who are looking, those are the third people, right? They're just looking in the market and not doing anything, right? Very important. So these are the people that we'll be talking about over this course: buyers, sellers, and people who are not doing anything. So for let's get back here. It was very important for me to explain about these three people, right? So let's get back to this side. So we're saying, what is bid price? Then I say bid price is the buy price. So this guy, the buyer, right, he has got money. So we are just saying that this guy has got money, right? But he has got the money, but he has got what you call a certain amount of money that he say he is willing to buy. That's what we call bidding price, right? The buy price, right? Buy price, okay, right? right? So we are saying amount of money, right, of money, amount of money a buyer, this guy, this guy, a buyer is willing to pay, right? I will explain, because this is very important, guys. So what about the ask? I've explained. So in simple terms, I've explained about bid price, just a buy price, amount of money a buyer is willing to pay, right? What about this? Let me write here, ask price. What about ask price, right? Ask price, it's amount of money, right? It's amount of money that this guy is willing to sell his stuff. Amount of money a seller is willing to sell his stuff, right? I won't finish. Is willing to sell his stuff, right? So you can see these two participants. We said we have three, but we're talking about two for now. Stick to what I'm explaining. Ask price is amount of money a seller is willing to sell his stuff. So we are saying maybe this guy is selling some fruits, his apple, for $5, right? So what happens in the market? A buyer will come with his money that is willing to buy this apple. So there will be maybe buyers that have got a amount of saying I'll buy for $6. Maybe another buyer $6, right? Then another buyer saying I have $8, right? Another buyer says I have what? $5. There are three buyers here. Sorry. Right? Sorry, let me wrap this. So stick with me here. I'm saying there are three buyers, right? The first one is willing to buy an apple with $6, second one $8, the third one is saying $5, right? So the thing is, in most cases, right, this guy, if it matches with the ask price, the amount a seller is willing to sell his bananas or fruit, the order will be filled. That's why we say an order is filled, right? These guys, they have a match, then the order is filled. So that's what we call what is on. I think I've explained enough about ask price and bid price, right? So the difference between the price for what is it, bid and ask, is what we call a spread. Because most of the time, let's say these guys, they come to markets, right, to buy with $5, right? Same market here, maybe there's a market here, he comes with these $5 to buy same apple, right? But the moment he turns around, right, with these same apples, now the buyer's got the same apple, now he's willing to sell it back to the markets here. He can't sell it for $5. He's supposed to sell it at a higher price, right? Maybe it's 6. So this difference between this, you've bought the same thing at $5, but now out of a sudden you need to sell it back. You're supposed to sell it at, so this guy is gaining a commission of what? $1. I think I've explained. Please be in mind with this concept. So that's what we call a spread, right? A spread is made by marking the spread wide. So most of the brokers is, they try to make this spread a bit wider, right, so that they make money. But it's a revenue. So as a trader, you should be very aware and check about these spreads. If they are wider, which means that broker is taking too much money from our account, right? There is what you call another revenue, commission. So commission is a certain percentage someone is doing a job for you. As we said, there was a flow here, right? An order goes here to a broker, so this guy should charge you a percentage of doing your job. That's what we call commission. So these guys, they get money from you, so you should check how much are you charged as a trader, so that you don't lose this slippage. It's a slippage thing, right? Don't just lose money that you don't know, right, in the markets, right? So, and financing 10, very important thing. So in simple terms, what we are saying about financing 10, we are saying someone, okay, there's a bank here, you know those loaning sharks, right? There's a bank here, right? Here it's a society. I'm trying to explain. Here they are society of people, right? I want to explain very clearly. People mislead each other, or YouTubers mislead each other about this, right? You are here, you are here, you come here and say no. Okay, banks generally, these are credit facilities, right? They loan people money, right? So usually you come to the bank and borrow money at a certain percentage, let's say at 2%, right? It gives you maybe 5 million, right? It lends you 5 mil, right? 5 million at 2%. You are supposed to pay it at 2%, maybe per annum, whatsoever. But you end up going back to the society, right? You know those loaning sharks, you start to lend it maybe at 3%, right? So this difference, we are gaining profit, right? That's what we call financing 10. We are gaining 1% of the 5 mil, right? That's what we call financing 10. OTC gain is just those market or market makers, or what we call brokers. They are betting against you. When you are losing, they are trading against you, which means they're gaining money. That's what we call I think I've explained about financing 10 OTC gain. Very important thing. I have seen YouTubers, they don't really explain well about this, right? So usually they say spread and commission revenues are well publicized, right? They should be well publicized so that clients can see, right? But however, you as a trader, you should be very careful. Check if these spreads are very wide, so that you don't end up losing money in the markets for unnecessary reasons, right? If the only revenue stream was spread and commission, the broker can make more money. Why? Very important point, because these guys, right, a spread, we say, and commission, we've explained about it, right? It's different between bid price and ask price, right? Right. So we are saying you don't need to claim about these definitions, right? You just need to know. Don't worry, you guys, right? So the more you buy in the markets huge quantities, or the more you trade frequently, the more these guys, they gain money from commission. That's why there was introduction of trading educators, people who try to persuade people to go and trade too much, so that you lose money through commission. You might not see it, but over time you are losing money. A 2 cents today in a year is something else. That is very important to know. So the more clients trade, the bigger size people trade, the more they are losing. So most traders, they ask, do you need to trade more frequently? Too much? No, you don't need. It's a big no, because you end up losing money through commissions and so forth, right? I've explained about bid price, right, and ask price, right? This difference, so the sell, right, the offer price, right? An offer price this side, right? This is the offer price where a seller is willing to say, I'm supposed to sell at this price, $1 or 126 what, and this is the buy price, right? Someone who is buying is saying, I'm supposed to buy in this, right? Can you see something? Very important stuff, right? The buyer here, right? The buyer here, or the buy price, right, is willing to buy, or is supposed to buy at 12614, right? But the seller is selling at this, right? Can you see something? This, you're supposed to buy at a higher price, but when you're selling it, you're supposed to sell it what, at a lower price. So very important stuff. This is higher than this, so that they make a spread, right? So when you are buying something, right, when you're buying something, you're buying it at a higher price. So you are buying this side. Generally, what you are saying, when you see this pattern in a platform, I will explain. What you are trying to say is you are buying at this price, right? But when you are selling at a low price, so you are losing money. The moment you buy, right, you can see there's 14, there's 12 here. You are buying at a higher price, right? This is the button that you press. You press this side to say I'm buying, right? You press this side to say I'm buying. You see this button, right, in a platform for a broker. You press this side, you say you are buying at a higher price. But when you are selling it to the broker, you are pressing this side to say I'm selling. Very sorry for that. You are selling at a low price, which means you are losing money. So the same thing is, we are saying this is what we call a spread. I think I have explained well. So when you buy something at market, say you buy it at $6. Sorry, my mouse. Very sorry, guys. So very important stuff for this button. You should know when you are pressing this side. When you see, I will show you. For now, just know when you are pressing this side, you are buying, right? As it says, you are buying it at a higher price. But when you are selling it at a lower price, which means you are losing this amount of money. There are sales, but over time that is very important. So the spread on forex market is the amount. We'll talk about pips. So the difference in money, or money, can be talked in terms of pips. I will explain. For now, just stick to spread, right? And bidding price, I've explained about it, where I said is the buy price, amount of money a buyer is willing to buy. You are willing to buy at this price, right? So most of the time, some brokers, they make this difference between these two values, so that they make a bigger revenue, right? The more people press these buttons, the more they lose, right? Since the spread takes a bigger part of forex traders' expense, it is important, very important, to consider it to everyone who wants to be successful in the currency. So it's very important for you to understand this terminology, right? How these guys, they're getting money from you, right? So very important stuff. So the broker, the trading educator, the retail trader, how the industry, I've explained, it's set up for you to fail, for you to lose money over time. So the more you trade bigger volumes and larger size of trades, frequency, you are trading too much per day, you are losing money in terms of spread and commission. So which means there is a conflict of interest, because some people, retail trading educators, people who are sent by brokers to you to say trade too much, trade like this, they are pushing what you call a false narrative to you to say do this, so that you lose money. Here they are explaining about financing 10. I've explained very well about it. I don't need to go and reread about this. So we are saying there's a credit line. someone has got a broker as a credit line with the investment bank, which borrows maybe this kind of money at this kind of certain percentage, maybe 2.75% per annum, then it end up going to retail traders to offer them leverage. You know, that man that I was saying, they borrow you money. So it's not like you're being borrowed for free. There is a percentage that you are being charged. That's what we call financing chain. You are being charged per trade that you get in, 3.75. You see, it's kind of higher. Now we're being charged 3.75, but these guys, they got that amount from banks at 2.75. Why can't you not go? That's the biggest $1 million question, to borrow money from a 2.75. Investment banks, they don't want to lend these people because you don't have what you call collateral, something that you can offer the bank to say, if I lose this money, you can take a house, you can take this. That's why these brokers, they are supposed to be there for you. You can't say we should eliminate them. So which means there are good brokers and bad brokers. We'll talk about that, right? So this transfers a risk from broker to a credit, right? So which means there's a risk thing, because these finance guys, investment banks, they are lending these brokers, these creditors, what we call investment, they are lending brokers some money, which means it comes with the risk. So they can't just come to you and give you it is same percentage, which is 2.75, right? They should put a markup because there's a risk, right? So that's the thing here that we're explaining. So there's no need so for me to really read about this retail, which means retail traders. You should be very careful, because in the industry there's conflict of interest. I hope I've explained very well about this. Thank you very much.